Hey, this is John, and this is our final group presentation. So, again, the thesis of our algorithm was that very large trades can lead to extremely profitable investments in financial markets. And specifically, we wanted to use our algorithms and identify things like this trade here on an energy ETF XLE, where about $250 million of the underlying were purchased here at a price of 55.56, but the close of the asset was actually at 55.83. And so because the close was higher than the execution price, we assume a buy here, and over the next about week and a half or so, it did really, really well. And similarly, in reverse, if the close was below the execution price here, we would assume a sell, and we'll see that later in our thesis. So initially, we got our data from CBOE LiveVol, and it kind of just came in like this, and we filtered it out for what we wanted, which of course was trades over 500,000 shares, and then we cleaned it up, normalized it, and we'll look at some of that information later. But really, the most important thing is that we found the difference between the close price of a security and the underlying block trade price of that same security. And so when we looked at the difference between these two mapped over a frequency span, what we found is that there was a very a pretty good bullish trend where the difference was positive for a bulk of the investments. And if you look very interestingly here at the shares sold difference pairwise execution chart, we found is that there was this big grouping of net bias positive buying trades, and then there was a lot that were really the buy, and then it went up a whole lot. And there were also these net sells. So there was a trade that executed, and then the price closed way, way, way below it. And so for these investments, we propose, and what we believe, is that these were selling investments, right? So we'll see how that plays into our algorithm later. But it was very nice that there was a very clear and distinct gap between the actual difference. Here you can't see it as well, but here you can see there's a very distinct gap, which makes it particularly simple to identify and isolate these extremely far out selling trends, and also makes it very easy. There's a gap here as well. You can see easy to isolate these extremely far up buying signals, whereas a lot of this is mixed. A lot of it is slightly neutral, slightly bullish. Here we have very clear differentiations between the two. Alongside that, we looked at the correlation between the, sort of all the factors here. And what we found that was really, really important is that the actual unit price and the close price of any given asset were extremely, extremely tightly correlated. And so even the smallest 20 or 30 cent difference for, say, a $40 security actually was extremely significant because of the relatively high and very tight spread correlating these two factors of our data. So that was really important later on as we looked more so at percent changes. And here's one of the biggest reasons that we moved towards percent changes. You can see the difference between the closing price of security and the execution price of a block trade. That's a really big, really, really widespread for lower priced assets, and then sort of a very, very narrow spread for higher priced assets. And so we kind of use that as an indicator that we should look more at percent difference instead of actual raw just dollar differences. And so we implemented that later in our data as well, to especially for the clustering algorithms, we had sort of the percent difference mapped instead. It was much better results. In addition, we found what's really interesting is that the bullish or bearish trend of any given investment was actually not very highly correlated to the time of day that it was made. So trades made early in the morning had the same likelihood, give or take, of being a sell as they did later in the day versus being a buy. So really interesting to see that very distinct trend here maintained throughout time in a very standard and linear way. It was one feature that was sort of removed from our necessary processing, especially later on in the neural net, because it was very normally distributed across the daily time frame. Speaking of time, we noticed that there were a vast bulk of the trades occurring in the latter half of the day, which is extremely normal for institutions and just any big investments. It's very normal for algorithms to make trades at the end of the day, especially at high-frequency trading firms. A vast bulk of the swing trades are made towards the end of the day, if not the last 15 to 30 minutes of the day. If you look at last 2 hours, it's like 80% of the volume. It's a very normal trend in the industry. So we had to sort of understand this going into it, because it had a very big impact on our k-means clustering algorithm, just because of the way that it kind of forms circles around those time frame periods. And we see here that the actual size of a trade was significantly much lower before the open, and then sort of later in the day, and especially at the close, you have much larger trades, much larger investments, much larger order size. And so we wanted to definitely take that into account, especially in our linear regression. So Here's our initial k-means results, and as you can see, the time value really overpowered our results here, just because it didn't have the fluidity to adapt to the other features of our data set. And so you see a lot of trades coming up into about noon, and then you have noon, everyone's kind of chilling out, and then sort of from the 2 to 4 o'clock clusters is really where we saw a bulk of the volume. And so not much useful insight here. It just shows that a very few people are trading before the market opens, and then it increases. There's a lunch cutoff, and then a lot at the end of the day. So what we decided to do is actually revise it and go through the GMM variance and clustering, and that was where we really hit our sweet spot, because instead of having just useless clusters, we actually had 3 very distinct peaks for buying, and then for selling, and also for maybe not so much, don't really know what to do with it. And these switched around a little intermittently, but because we had that ability and that variance sort of built into the shapes of the clusters, we really were able to get a much better and really a very nice spread here. We were really happy with this, and so because of that, we jumped into linear modeling thinking it would do fabulously. And unfortunately, our initial linear regression, although it had a correlation of 0.95 r squared, it didn't really fit this trend very well, and a lot of that was because, as we saw earlier, there was a lot of bunched up data that was kind of in the middle, and that bunched up data here skewed our r-squared correlation, and it really kind of skewed our whole trend, because it looks really good at the beginning, but in the trades where it deviates a lot from the standard position, which is where most of the money is to be made in the investing algorithm, the regression is just very, it leaves a lot to be desired. It really inaccurate, especially at these high beta values, which is exactly where a vast bulk of the actual money is to be made with these investments, where there are large deviations from the buying and the selling price. And so what we decided to do is normalize the information, like I talked about earlier. We mapped everything to a span of 0 to 1, specifically with percentage differences. We took z-scores and mapped those on a standard deviation from -6 to 6, just because there were some extremely large sigma values for some of the smaller securities. We did have to cut out a lot of the securities priced under 3 cents, and some that were under 20 cents, just because they didn't have accurate pricing information, or the spreads were too wide to be suitably traded. But for a bulk of them, they fell sort of within this one deviation away from one deviation normalized by 6 sigma. So just like any other standard normal distribution, you still have that bullish bias. And so using this new information, we ran the regression modeling again, and we got a very, very similar result. Again, not a great fit, and our correlation actually went down because we normalized it, so that would make sense, and it actually went down to 76%, which isn't terrible. It's okay, but it really just wasn't great, especially considering we weren't classifying anything going into it. It just didn't really perform as we expected, and it didn't have the trend accuracy that we needed for a trading algorithm. And so instead, we decided to implement a neural net, and we basically trained it with a 70% representative bias of our data, just because 80% was just the overfitting on it was really harsh at 80. So we did a 70% training set, and the accuracy we had on that for classifications, basically our classification bias, and our final result was 0. It was right. The investment, it made money. It was great. The algorithm was right. Versus sorry, the other way around. So that'd be a 1, and then a 0 would be it was wrong, right? So 1 right, 0, you messed up, you lost, you're wrong. And what we found on a long only net bias, just for long equities on a T+7 basis. So you make the trade the day the block trade occurs, and then you wait 7 days to identify whether or not you were correct in a long investment. We hit about 56% testing accuracy, which is absolutely phenomenal. There are multi-billion-dollar hedge funds built on 55%, 5% alpha, 6.5% alpha is phenomenal. And we were really, really happy with the neural net. It was much more dynamic because it allowed us to really, with the sigmoid function, kind of shift around our weightings for the given factors in our algorithm, and we were really, really happy with the results that we got there. And of course, documentation for all this will be in our GitHub page. So the implementations in this, with this high success rate, we believe we can get it up another 10 or 15% by implementing a long short strategy instead of just a long bias strategy. And if we can do that, we can get accuracy up to around 64% or so, with an average risk reward around 1.4 to 0.8. We believe we can have a very solid performing algorithm that should be able, with a 50-50 split, if we can get up like above 60%, we should be able to implement trades that are based on 50% equity, 50% long calls, or whatever the directional option is. And with that, I'd say, maybe a 10 million fundraise on that. You could do 5 million is 50%. You could do 10% positions at about 500,000. Should be able to leverage that. And even if you just want to do 60% equity, you're looking at really solid performance there with the numbers that we're looking at, and those risk reward ratios based on essentially 1 week, validity trades, and then T plus 10 for closing trades based on a little bit of discretion. You've got a really nice application here that could do really well in a fund. So we're excited to work on that in the future. And we also think that there are a lot of applications here that we didn't really talk much about just for time constraints, but a lot of applications in 0+ high frequency trading that you can use to make a fairly nice little spread on these as block trades rolled out. And that's another application of this that we would like to explore more in the future. So thank you so much, and just explore the GitHub page for all the technical documentation and a lot of the actual info on the underlying algos. Thanks.